Today we'll discuss our module 4, analyze the capital investment appraisal for taxation purpose. So how capital investment do with the effect with the tax. So here we'll understand, we will analyze the analysis of capital investment appraisal, capital investment appraisal techniques, analyze for implementation of tax, analyze of operating and financial combined leverage EPS, analyze of total leverage effect, etc. within this module. First of all, capital investment, that means also we know it, the capital budgeting is the primary planning process with the facility to determine the concerned investment for the company. So if we see here for how we do it, firstly, we have to forecast capital requirement, how much capital money or we need it, part of the corporate business strategy, and identify suitable project where we will invest it, and we have to appraise potential project. Here we have to assess cost benefit analysis and project overall lives, and using the different types of technique we have to select or approve for the best alternative and make capital expenditure, and we have to compare with the actual plan expending with the we need to monitor the project. Fundamental techniques are that means we are using net present value NPV and internal rate of return IRR. Sometimes we are using payback period and also accounting rate of return. And there are different types of technique we are using, basically NPV, IRR, accounting rate of return, profitability index, equivalent payback period, etc., discounted payback period. But there is some difference between here the techniques. One is, for example, NPV IRR, they are considering the time value of money and using the whole life of the project. But payback period or accounting rate of return, they do not include the time, consider the time value of money. Tax implication, if we see here, taxation has to be taken into consideration when making investment decision. Tax will have to be considered in cash flow of the project when discounting the arrive at the projected NPV. So how we calculate it? This way. This is the template of tax adjustment. Here, cash flow before tax, if we see the left side, and adjustment with the right side. So investment cash flow, here no adjustment necessary. Investment cash flow, where how much money we are investing in the 0 year. Cash flow does not affect taxable net income in the 0 year investment. So working capital cash outflow and inflow, here also no need for adjustment. And revenue cash flow, that means how much money come from the cash flow. So we have to adjust with the tax because multiply by the 1 minus tax rate. For example, if our tax rate is 30%, then we have to minus from the 1 minus 0.3. That 1 means 100%. So this is the tax effect, and also expense cash flow also we will adjust with the tax. Tax assumed to be paid a year in arrear when doing discount cash flow analysis. So here it is the important consideration for tax consecution. Here we have to think capital allowance and depreciation and disposal issue, etc. So a system approach for tax design for inclusion growth. How? Look here, design for individual tax system factors is that tax administration and tax enforcement. Always we have to consider when they can go for a plan for business or also investment in capital budgeting and etc. and capital machineries etc. So we have to think the tax consequence. That means how tax effect with that, tax complexity, simplicity, etc. Tax inclusion need, it is the factor for a good system, and not tax system is that economic structure, labor, capital, etc. is the input of the production. So efficiency and equity implication of tax, we can adjust with the tax system factor and non-tax system factors. So tax effect in investment decision. If one refers only to investment decision, having in the mind that corporate profit are the source of the fund used to finance an investment, corporate income tax seems to be one of the main determination, because where profit comes, there tax also comes. If profit, then tax. It is the expectation that marginal average tax rate to have a negative effect of investment decision. So sometimes if no profit, but sometimes tax have to pay because of minimum tax. So how to tax impact investment decision is the question. I will go this also again. So companies that pay income tax must consider the impact of income tax, have to cash flow of long-term investment and make the necessary adjustment. Investment and working capital cash flow are not adjusted because the cash flow do not affect taxable income. Revenue cash inflow and expenses cash outflow are adjusted by multiplying the cash flow by 1 minus tax rate, we know it. And although depreciation expense is not a cash outflow, it provides tax saving. So why depreciation? That's why when we go for cash flow, preparing cash flow statement in indirect method, from the net profit or net loss, we add their depreciation or amortization because it is a not non-cash item. The tax saving is calculated by multiplying depreciation expense by the tax rate. Once these adjustments are made, we can calculate the NPV and IRR. So here, this is also again how take a project within a company, have a good idea on realize the need for the project, and look for the suitable project, and then this is the cycle of the project choice. Choose the project and identify the consider alternatives, then carry out financial analysis. There we are using capital investment appraisal, that is capital budgeting techniques, all type of tactics using here, and that analyze the alternative and identify feasible alternative. Then we have to choose the project to undertake, and then continue monitor project along with the rest of the organization, carry out post-completion audit. So this is the cycle of taking a project or project implementation. And there we taking the decision, and based on that, we use different types of payback period, accounting rate of return, etc. So we are not going details with the techniques, but we just for understanding, we'll see few math here. Look here. Here is NPV with tax effect. Net present value with tax effect. So one company would like to purchase a new machine. For example, its price is $4 lakh. The machine will have a life of 4 years with zero salvage value and is expected to generate annual cash revenue for 1,80,000 per year annually. Annual cash expenses excluding depreciation will total 20,000. The company used the straight line depreciation method. We know there are different types of depreciation method. Some are straight line, some are diminishing balancing method, etc., residual method, etc. And that's for the difference, our deferred tax come here for because National Board of Revenue in our tax authority, they are taking one types of depreciation method, but we are in our company we are using another type of depreciation method as prescribed at the International Accounting Standard. So that's why deferred tax occurs. Here some has a tax rate of 30% within the company. They require a 10% rate of return because company wants 10% rate of return. So what we have to do, we have to find the net present value of this investment. And should this company purchase the machine or not, we have to explain it. So this is the fundamental figure. Price of machine 4 lakh. Life is 4 years with 0 salvage value. And annual cash generation $1,80,000. And expense required per year $20,000 excluding depreciation. Tax rate 30%. Depreciation method is a straight line method. And required rate of return 10%. So why this 10%? We have to find out after taking the NPV or IRR or any another technique. After using, we have to find out, for example, in NPV, if the NPV is positive or greater, then we should accept the project. And in the case of IRR, if the IRR is more rate than the required rate of return, then we should accept it. So this is the fundamental condition. So now if we go for the calculation, the NPV, so in the year 0, in the first year, purchase 4 lakh machine. In the 0 year, in the first year, after tax cash revenue, that means what we find here, the initial investment purchase price does not directly affect the income and therefore not adjusted with the income tax. One thing, that all are adjusted, but why in the 0 year the purchase amount not adjusted with the tax? Because of that time no effect. That means investing the amount, no effect is the tax that times. So after tax cash revenue, amount equal to the cash revenue before tax, that was 1,80,000. So how it will adjust? Multiply 1 minus tax rate. So here, so how it's just 1,26,000? How come? Is the adjustment with the tax rate. It is the cash after tax cash revenue. Cash revenue is 1,80,000, but after adjusting tax, it's come 1,26,000. So here putting, because the life of the project is 4 years, so here putting 4 in the 4 years, year 1, 2, 3, 4, 1,26,000. And after tax cash expense also same way. Here cash expense per year is 20,000. So if we adjust with the tax, it's come 14,000. How come? 20,000 multiplied by 1 minus tax rate 30%. So it's come 14,000. So this 14,000 for the year 1, 2, 3, 4, all are the same because life of the project is 4 years. Now depreciation. So depreciation we have to calculate. Depreciation tax saving. Why this with the tax adjustment? Because depreciation we are putting with the, we are showing in our financial statement, profit and loss account, and also it's an expense, and DCT allowed it as an expense. But this expense is the really not happening because no cash out by the depreciation or amortization. So there are some tax benefit, because if this expense allowed, then we have to pay the tax, less tax. So that's why here tax benefit calculated with the cash flow or our net present value for decision making. It is the not for other work, only for decision making. So depreciation expense, if we multiply with the tax rate, then what will happen? Depreciation expense here, depreciation is 1 lakh, because total cost of the machine 4 lakh. If we divide with this life 4, then we'll get 1 lakh. 1 lakh for the depreciation for per year. So with this 1 lakh, if we multiply by 30% at the tax rate, so here come 30,000. So here this putting here the positive 30,000. So here we calculate NPV as shown in the figure. This now the total cash in out. So in the 0 year 4 lakh, first year inflow is 1,42,000. Same way second, third, and fourth year 1,42,000. And now we have to multiply with the PV factor, present value factor, at the rate of 10%, because as per the question here said 10% rate of return. So this percentage we will use for calculating for the present value factor. So if we go for the PV factor sheet, or also we can calculate through our calculator, that means 1 divided by 1.1, then we'll get 0.9091. So if we multiply 0.9091, it is the PV factor of first year at the rate of 10%, with the 1,42,000, then we'll get 1,29,092. Same way in the year 2, PV factor is 0.8264 at the rate of 10% PV. So that if we multiply this with third years and fourth year, they will get, this is the present value of first year. So first year present value is 1,20,092. Second year's present value is 1 lakh, that means inflows value is 1,17,349. Third year's 1,06,685. In the year 4, the present value inflow is 96,986. So if we add all present value from the year 0 to 4, we will get this positive thing, 50,112. This is the net present value. So here said that the NPV 50,120. So this we calculate the NPV. Now the decision for the project. Yes, the company should purchase the machine. Why you did purchase? Because the positive NPV, that means 50,112, show the return of this proposal is about the company's required rate of return 10%. If the required rate of return 10%, based on that, net present value is positive 50,112. So company should accept this project. So this is the one in net present value calculation. The same way another one here, you can do it. So look here, and this is a math. Within this math, most of the technique is within in one math. So after completing this math, we will be understand what is payback, discounting payback, accounting rate of return, net present value, profitability index, internal rate of return. So here 1, 2, 3, 4, 5, 6, 7 techniques within in one math. So here company in the 0 year, that means in the 0 year they expend $1,50,000 on a project. Its life is 5 years, or life is project 5 years. So here is the cash inflow. How much money in the 5 year will come through the project. In the year 1, 70,000, 2, 60,000, 3, 30,000. In the year 4, 20,000. In the year 5, 10,000. So this is the cash inflow. And here the PV factors they include here, because you do not need to go for the sheet for find out the present value. So here we have to calculate the payback period, discounted payback period, accounting rate of return, net present value, profitability index, internal rate of return. And we have to choose here cost of capital is 10%. So this is the base, that means 10% cost of capital. So now before starting the math, we will discuss this all formula here. So look here, payback period. So what is payback period? So when we will invest in a project, how quickly the money come to me. This is the payback, how pay back it. And we have to choose that item where payback period is calculated, how shortly the money will come in our pocket or come our bank. So this is the payback period, and within this payback period, and there is a good thing is that it is very much easy for calculation, but bad thing is that it's not considering the time value of money. Because today if we invest 1 lakh and 3 years later we will get the 1 lakh, so it is not the it is the meaningless, because day by day our money is losing your purchasing power, and always inflation is going on. So today's 1 taka, tomorrow's 1 taka is not the same. So this is the time value of money is the factor. Also payback period, it is not considering the total period of the life. And then payback period also calculate how when we will get the money, they just calculate that period, not total period is including. So this is the payback period. So payback means that when exactly do we get our money back? When does our project break even? Figuring this easy. So it is very much easy for calculation. This is the cash flow as given in our box in the question. In the year 0, there 1,50,000 is the outflow. So here we another column we have to include running total. In the year 0 is the 1,50,000. Then in the year 1, cash inflow comes 70,000. So if we minus 70,000 with the 1,50,000, then only 80,000 is minus, because we get 70,000. We also need 80,000 for the break even. So after first year, the project has not yet been break even. Then year 2, again we get 60,000. This 60,000. Here 70,000. This is in the year 2nd, 60,000 cash inflow come. So here putting the 60,000 and 60,000 positive, but our balance was 80,000 negative. So negative is 20,000, because we also require 20,000 again for break even our project. So after 2nd year, the project has not yet break even. Only require 20,000 for break even. In the year 3, here cash inflow is 30,000. So look here, in the year 3, this 30,000 putting here is come the 10,000 positive. So we have to find the break even, so that project break even sometimes in the year 3, but no need for total amount in the year 3. So how we will calculate it? Now present value, look here. Here in the year 2 is only required 20,000. But in the year 3, here positive, that means over 10,000. So here base is 2. So our break even would be 2 plus. So here look, we have this 2 is the base, then fraction we have to calculate how much money required in the base year. Here we are talking that year, so fraction before that means 20,000. This 20,000, if we divide the cash inflow of next year that means third year. So here third year 30,000. So here 0.66 comes. So with this 0.66 we have to add 2 plus 66 or 67 we can say it. 2 plus 66, that means it is the break-even of the project. So payback period is 2.67 years. This is the payback period calculation. Now go for discounted payback period. So what is discounted payback period? Payback period we have seen here, look here, only calculate 3 years but not totally 3 years. Cash flow of 3 years taking but partial of year 3. Here also we remain in the year 4 20,000, in the year 5 10,000. So এখানে only here given only 3 years calculation partial. Now payback period, discounted payback period, it almost the same as payback period, but before you figure it, you first discount your cash flow. First have to discount the cash flow. So here considering the time value of money, that time value of money not considering here. For example, we invest in the 0 year, that means now 1,50,000. This 1,50,000 we will get within 2 years, 2.67 years. So they are not considering the time value of money. So because in the year 0, 1,50,000 and taking money within 2.67 years, 1,50,000 is not the same. So this here is not considering the time value of money. Now here considering the time value of money, discounted payback period, you reduce the future payment by your cost of capital. Why you will do it? Because it is money you will get in future and will be less valuable than money today, because today's money is more strong than tomorrow's money, and future money is less valuable than today's money. If you understand, for example, let's say the cost of capital 10%. Also your question is saying that cost of capital is 10%. Now within the 10% factor also given in our question, PV factor 10, in there 1.9091 up to year 5 0.6209. We will calculate this one. Look here. So here in the 0 year, no need for adjustment of with the PV factor, because it's just investing that time. So here running total 1,50,000. Now year 1, what we have to do, look here, 70,000 multiply by 0.9091. So this 0.909 year is the 10% PV factor in the year first year. So with adjustment, this 70,000 comes 63,637. So this 63,637, if we adjust with our required money, that we need to break even 1,50,000, then also require again 86,363. And in the year second, our cash inflow is 60,000. And if we adjust with it, this adjustment also taking here, that's why I'm not putting there, this 60,000, if we multiply 0.8264, then we will get 49,584. So this 49,584, this one. So this also the second year cash inflow after adjustment. So this 49,584, if we adjust with our running total, then also again we need 36,779 taka. This is our requirement for the break even. And the year 3 cash inflow is 30,000. If we adjust with this 30,000 with the PV factor, this one in the year 3.7513, then we will get this one 22,539. So this, after adjusting with 36,000, again we require 14,240. We require it for break-even of the project. And the year 4, 20,000 cash flow. With this, if we adjust with the PV factor, we will get 13,660. So again we require 580. And in the year 5, 10,000 is cash inflow. Look here all cash flow come here, and discounted with the discounting factor, we get 6,209. And this 6,209 is the more than 580. So here positive 5,629. So here base our break-even will be in the year 4, because here, look here, in the year 4 is the base one, and fraction would be 580, this one, and divided by taking the adjusting thing. But previous one, it was the only one cash flow, the 30,000, this 30,000, this 30,000 here. But here with that 30,000 were in the year 3, but we are here taking in the year 5 here, because for taking break-even of this project, we calculated it, and here 6209 is coming here. So here 0.093 is the fraction period, the break-even, and total break-even is in the year 4.093 years. So 4 years plus. So this is the discounted payback period. So what is the difference between payback period and discounting payback period? Payback period do not consider the time value of money, but discounted payback period, they consider the time value of money. So this is the basic difference. And now accounting rate of return. Another item is easy, but this accounting rate of return not depend on the cash flow. It's depend on the profit. So, but here do not give any profit with this question. So here assuming that it is also a cash flow is also the post profit. So based on that, we calculated here, and also this is the formula also. Accounting rate of return, we can sometimes is also called the average rate of return. So here look here, average annual profit, how come? Total profit during the project divided by the number of year of the project, multiplied by 100, divided by initial amount invested. So this way can be accounting rate of return come, and average annual profit come this way, total profit during the year divided by number of the year of the project. So this is the cash flow is assuming is the earnings. So total 5 years cash flow is come 1,90,000, and if we divide in the year 5 years, then we will get 30,000 is the average profit per year. So here 30,000 divided by 1,50,000 is the initial outflow, multiply by the 100. Then accounting rate of return is 25.33%. Sometimes it can be average rate of return. So what would be the average rate of return? Average rate of return, average investment, that means average income divided by average investment, multiply by 100. We also calculate this way. Look here, this is the accounting rate of return, and also we can say that average rate of return, this way we can calculate. How? This 30,000 is the average earnings per year divided by average investment, So here only average investment, how come? In the 0 year, invest in 1,50,000 and no investment or inflow or outflow within another year, so is the 0 and divided by 2, so it comes 75,000 as per the average investment, as per our formula also. So this comes 75,000, multiply by 100, then we will get 50% is the average rate of return. But it is not logical. But it is the logical. Accounting rate of return is 25%. So is go for that means accounting rate of return or average rate of return. Now
Sir.
the most, yes.
স্যার বলছিলাম স্যার এভারেজ ইনভেস্টমেন্ট যে 2 ইয়ার্স যে ভাগ করলেন এটা আমরা কোথায় পেলাম স্যার?
এটা হচ্ছে কি যে আপনি যে এভারেজ বাইর করতে হয়, এভারেজ কখন হয়? আমার তো গড় বাইর করে, যেমন আমরা বের করলাম, গড় বের করলাম যে এই যে আমি যে ইনকাম
ঠিক আছে স্যার 5 বছর দিয়ে ভাগ দিলাম,
আর এইটা এভারেজ কখন হবে? কারণ শুরু এবং শেষ ডিভাইডেড বাই 2, ওপেনিং 1 ক্লোজিং 1, 1 1 2, ওইভাবে এভারেজ করা।
ও আচ্ছা স্যার।
Okay sir, then now it is the very important for the net present value. We always use it. Net NPV IRR is a very vital and common thing for the accountant. So once you understand the discounted payback, NPV is so easy. Here we are saying that NPV is the final running total number. That is the example is the NPVs that all here we are taking that. Basically NPV and discounted payback are the same idea, but NPV taking the all cash flow. Payback period not taking that all cash flow, because only break-even point they close it. So discounted payback is a period of time and NPV is the final amount. You get it adding all the discounted cash flow together. If the NPV is positive, then we will approve the project.